Hello, my name is Aaron Witten. I'm the owner and founder of Witten Financial Services, located in Litchfield, Kentucky. Have a specialty in the toy and game industry, but this seminar would be applicable for most business owners, even though we might have a toy and game industry focus. So today, I just wanted to give you a sample of the first of hopefully what will be many webinar presentations of virtual seminars that I actually give at trade shows all across the nation. But this is the basics of my Finance 101 seminar. So let's go ahead and get started. My background is a certified financial planner, certified retirement counselor, and a certified kingdom advisor. And basically, I do all sorts of work in finance as far as personal investments, retirement planning, estate planning, small business consulting, QuickBooks consulting, accounting, tax work, you name it. If it involves a dollar, I pretty much do it with the specialty of, as I said before, the toy and game industry and with small business owners. This is a presentation similar to what I would give at Gen Con, Origins, AC Games Day, or many other trade shows in the game industry. So let's continue with that track. To understand how to do business in the game industry, you've got to understand the term three-tier system. Now, the three-tier system basically means you've got your retailers as your top tier, your distributors as your middle tier, and your manufacturers as your ultimate producers of your product that you sell. So let's look at that in a little more detail. The retailers normally buy a product at 45 to 55% off retail in our industry, or MSRP, manufacturer suggested retail price, to hopefully sell at full MSRP. Sometimes you'll get a little more, sometimes you'll get a little less. I'm a big believer in not discounting because if you run a good retail establishment that's clean and welcoming environment with organized play, rarely do you have to discount. So keep that in mind as we go through our presentation. Typically as a retailer, especially when you start off, you're not going to be big enough to buy directly from a manufacturer. So you're probably going to buy ones and twos of things from the distribution tier or from a distributor. Some of the more popular distributors in our industry, Alliance, ACD, Southern Hobby, PhD, and many others, right, are here to serve your needs in that capacity. And a good way to meet them is at the GAMA Trade Show coming up in Reno here in just a few weeks. At which I'll be giving presentations as well. Distributors normally will sell to you at about a 47 to 55% off MSRP, which fits in your target margin as a retailer you want to see. But in order to do so, they're going to have to buy at about 60 to 65% off MSRP. Now, to put this into terms of some real numbers, let's say, for example, as a retailer, you're buying a blue widget, and that blue widget has a $10 suggested retail. You're going to want to buy that blue widget from anywhere between $4.50 and $5.50 in actual dollars. So that would be the 55% off to 45% off if you do the math. The distributor is going to sell that blue widget to you at anywhere between $5.30, typically on the high end, maybe as low as about $4.50 if you do the math on the 47 to 55% off. But they have to make money too. So they typically are going to turn around and buy from the manufacturer of the blue widgets in bulk quantities at a 60 to 65% off suggested retail price, which means they're going to be paying $3.50 to $4 for those same blue widgets and marking them up a little bit so you don't have to buy a gross at a time. Or carry lots of inventory. You have a chance to buy things one or two at a time from a distributor and not have a lot of risk and inventory carrying costs as a result. So distributors play a very important role in the three-tier system. Now going down to the producer's tier or the manufacturer's tier, they oftentimes only sell to distributors. Now there are a few manufacturers that will sell to you directly if you can buy in pallet quantities or in very large quantities. It's probably rarer today than it was back when I started my retail company, Game Station, back in 2002. And so the thing is for historical significance, the slide's a little dated, but I've got on here that companies like Mayfair, Days of Wonder, WizKids, Playroom Entertainment would sometimes sell directly to me and would sell at a little bit better margin than I could get through a distributor. Remember, a distributor, I'm going to buy at 47 to 55% off retail. A lot of times they would sell to me at 50 to 55% off retail, but I was writing multi-$1,000 orders at a time. And typically it was only on the very few things I sold in large quantities. So you can get maybe a few more extra points of margin by going direct to a manufacturer. Most retailers, I don't advise this, especially if you're starting out, because you could end up buying a pallet full of something that you may have only needed 4 or 5 of to get through your sales rush, and then you've got a whole lot of inventory sitting there that you may have to liquidate eventually, or be it not be able to get your money back out of. So again, the 3-tier system, to summarize, would be retailers buying from distributors, buying from manufacturers, or in reverse, manufacturers selling to distributors, which then turn around and sell to you as the retailer. One other advantage I want to plug here for my distributor friends in the industry, many of which I maintain great relationships with when I had my toy and game company, is that another big advantage they offer that direct manufacturers have a hard time doing is they offer low free freight minimums. Now, what do I mean by that? Well, let's say, for example, you call up whatever distribution house you want, and you say, hey, I want 1 of these and 2 of these and 4 of these and 2 of these, and you could order 50 different items from them. And the total of your invoice might be like $400. Well, I know Alliance, ACD, Southern Hobby, PhD, many of the people that I've mentioned before will all say, you know what, that's a big enough order to where we're going to ship it to you for free. Now, those minimums change from time to time. They tend to go up. But, most of the time, distributors will ship to you for free for under $500 order. And for $500, you can get a lot of variety in your inventory without having to put a lot of money into any one item. So again, I feel distributors, for the margin they charge, play a very important role for young retailers because you don't have to spend a ton of money to have a large variety of product. And then once you get your store up and running in a large variety of product, you can see what's selling, see what doesn't sell, and then spend your profits on restocking deeper the things that do sell, starting to build a community, starting to build some volume in those things. So that explains the 3-tier system in and of its entirety there. So let's move on here to some important business documents and metrics that you will want to be measuring in your business. Now, I typically I understand my background. My background is finance. My background is accounting. So I came into the industry not as a hobbyist, not as a gamer necessarily, although I did play my fair share of Magic in college and Settlers of Catan and a few other favorites. I came into the industry as a business person or as someone very intimate with numbers. So to me, it seems like you would always want to make sure that you're going to have visibility on these 3 main documents at all times in your business, because rule number 1 for me being in business is you got to make money. Businesses that don't make money are called hobbies, not only by me, but also by the IRS. It could get you into some trouble if you open a game store and year after year after year you are not showing a profit. Because the IRS could come back and disallow all those write-offs you've had over the previous years. It could get you in a lot of hot water. So you need to make sure that when you open a business, you have every intention of making money at some point. That doesn't mean you have to your first year or maybe even your second year. But at some point, you're going to want to show a profit. Elsewise, it probably would be less expensive for you just to go back to becoming a hobbyist rather, and going back to patronizing another friendly local gaming store. So these important documents You'll hear me make mention of these a few times. In short, are your profit and loss statement, your balance sheet, and your cash flow forecast. And again, you can run or know the health of most businesses from these three documents. We'll talk a little bit later about how you get these reports, but right now let's take a deeper dive into what is on these reports that is so significant to help you run your business. The profit and loss statement, in my opinion, is probably the most important of the three documents when you're a small business owner, because you got to know what you're selling something for, what the margins are on it, what your overhead is, and if you're making money by the time you pay everyone. And you can learn all of that from a profit and loss statement. Profit and loss statement also is called an income statement in some softwares or in some other areas in the world. So those two terms are interchangeable for this discussion. So there's 5 important figures I teach people on any profit and loss statement. Now, the reason I'm going to boil this down into just 5 numbers is because, when you're a small business, it's going to be a lot easier to read your profit and loss statement versus if you're a big multinational corporation like Walmart. Walmart, the last profit and loss statement I looked at for them, being a publicly traded company, you can get that information. But the last P&L statement I looked for them was over 40 pages long. And obviously, even for someone that has certifications in accounting and finance, that's quite a daunting task. All right, if you don't know what you're looking at, you could make your head swim. So, in short, on any P&L, whether it's Walmart's, whether it's yours, or small business owners, there's really only 5 numbers on there that can tell you how healthy your business is or not, right? So we'll start at the top of it, and I'll try to show you an example a little later on to kind of solidify some of this. The first thing is your gross income. Now, the gross income is what a lot of other people refer to as total income, gross revenue, sales, if you want to call it that. Basically it's money in, all money in. So, you might have a cash register, help keep track of that. Heck, you might just have a cash box and look at your bank deposits, whatever. But gross income is probably the easiest thing on this list to measure without any sort of sophisticated accounting techniques or software or anything of the like. So, gross income is the first thing you want to look at in your business. The second thing you want to look at is your cost of goods sold, or COGS for short. You will oftentimes see it abbreviated as COGS. Now, in particular for the game industry, I put a subnote in here that you want to see a cost of goods sold that is less than 50% of your gross income. And we'll see why in a minute when we start putting these puzzle pieces together. But that's just my general rule. High level 30,000 foot overview. The first thing I ask people when they come to me for business advice is, I have them pull these 3 documents, but one of the first things I look at is how much is their cost of goods as a percentage of their gross income. Now, remember from our first slides where we were talking about the 3 tiers. From distributors, you should be able to buy most of your stuff, 45% off or better. There are some exceptions, right? A lot of your collectible card games and a few other product lines might be what's called short discounted, where you may pay as little or as much as 35 to 40% of retail. But we'll also talk in a minute about maybe how to make up some of that extra margin to get you back up to this 50% ratio. When I give this general advice, right, understand that, it depends on where you're at in the world, what the market is, what your expenses are. These are just general ratios I give to small business owners to stress test their plan. If these ratios work for your business plan or for your business, you won't have any problem making money. Understand that these ratios can be squeezed to some extent, depending upon what your business model is, where you are in the country, and how well you manage your company. So understand these are just the generalized ratios saying, hey, you're not going to get in trouble if you're at or below these ratios. So keep that in mind as we go on this presentation. So back to the slide. Yes, you want to be at less than 50% on your cost of goods sold, meaning if you're going to go back to the example of the blue widget that sells for $10 retail, you want to be paying $5 or less for that blue widget to be selling it at 10. That would put you at a 50% or less cost of goods sold. Now moving on, the third number you'll see on a profit and loss statement that is of significance is your gross profit. This is also referred to in other circles as profit margin, contribution margin, or just margin. In general, you want to see more than 40% here, right? And that's because this is what you have after selling the item and replacing it on the shelf to help cover your overhead, your rent, your utilities, your lights, your employees, things like that. So I love to see ratio here of 40% or more. So going back to our blue widget example, you sell the blue widget for $10. Let's say, for example, you had to pay $5.50 for it. It's a very popular blue widget, so you've only got $4.50 left in gross profit. That leaves you 45% ratio, which according to my very high-level analysis is considered healthy. Now, obviously, if you're following the rule from cost of goods sold, where you're at 50% or less, this number should be 50% or more because they are direct inverse to each other. You subtract one and you get the other. So the thing is that while it seems like these two rules might be contradictory to each other, understand I put this in here for the reason of I have been in analyzing businesses for 20 years now, and I have actually seen businesses maybe violate one rule but not violate the other and be totally okay. So that's why those two rules don't quite line up with each other. Again, this is just what I look at on a high level to just check off on your business and say, yeah, you should be fine. If you fall under all these ratios, you're going to be rocking it. So moving on here, gross profit then goes down into, we take our gross profit, and that's what we use to pay our overhead. Overhead, or fixed expenses, which is our fourth bullet point here, cost of business is another way I've heard it, basically is all of your fixed expense, or all of your expenses that are going to happen anyway, whether or not you sell anything that day. So things like your phone bill, and your light bill, and your water bill, and your property taxes if you own a building, or if you have a commercial lease on a building and have to pay the property taxes for the landlord. It includes your employees. It includes supplies you need for the store that you're not reselling, but things like toilet paper, things like napkins, things like plastic bags or paper bags if you want to give people a shopping bag when they carry something out of your store. All those little things fall into your overhead. And so the thing is that on your overhead, you want to see less than 50%. Now that's going to be very tough in the beginning because you have no sales. So overhead is infinite compared to your income. Hopefully that will not be the case for too long, but after you've had a few months of data, maybe 6 months or a year, hopefully your fixed expenses are no more than 50% of the overall money you're taking through the door. If you can get under that, then you're probably going to be fine, if you're able to buy under the rules I gave you previously. Because basically, you take your gross profit, you subtract your fixed expenses, and it leads you to your last part of your equation, which is your net income or your net profit, or just profit if you want to call it that. This is why you should be in business right here. You should be in business first for profit. Now, I get questioned a lot because there's a lot of people that are hobbyists, there are a lot of people that are creatives and are very excited about being in the toy and game industry, and I don't blame them one bit. I've made some great best friends, lifetime friends in this industry, and I wouldn't trade them for the world. I wouldn't trade the experience for the world. But one thing that when we ran our company, I was insistent upon is that we were there to make money. Now, having fun can be a close second. I'm not saying you have to just, put your head down and work constantly and not play a game with your patrons or not DM a group on a slow night or something like that, or be part of the games that you enjoyed that probably got you into this business to begin with. But understand, I've also consulted with a lot of people that wanted to own game stores, thinking it was going to be them sitting around playing games all day and having fun. And I can tell you many horror stories of people that thought it was going to be that way that ended up losing massively on the financial side. Not even, just their business, but maybe their home in some instances, because they let the hobby side and they let the fun side of the equation become their first priority and not the making profit. The way I explain net profit to gamers in particular is basically it's like surviving and going to the next level, right? If you don't have a certain amount of dollars hit the bottom of this sheet, then you can't advance to the next level, right? Because you haven't mastered this level yet. And so the thing is that profit's not a bad thing. It's fine to make a healthy profit in any business you're in, and if you're blessed to make excess profits some years, you're welcome to turn around and give that back to your community, to your charitable organizations, or maybe even to your player base as some sort of player dividend or something. It's okay to make the profit, then turn around and give it away and have fun with it. It typically does not work out for you to start giving away potential profit because potential profit rarely materializes. So just keep that in mind. Now, the reason I put down here you want to see more than 7% on your net profit is this. Most businesses will take on some degree of debt at some point in their business, either to start up, to expand, to finance large inventory purchases like at Christmas time, things like that. And so one thing you do not see in a profit and loss statement that you'll see in the other documents is that debt. You'll see the interest from that debt accrue on your profit and loss statement as an expense, but you don't see the principal payback of that. So having a net profit that's above zero, and in this case 7% above zero, gives you dollars that you can then turn around and pay your debt back, right? Because just because you made a profit during the year doesn't mean you're going to have any money. This is one of the biggest disconnects I see in people I consult with and do seminars with. They'll show me their P&L and they're like, well, we made $50,000 last year net income. Why don't we have any money? And most of the time it goes one of two places, at least for this industry. Number one, it goes into repayment of debt. Okay. And debt can also include money that you put in personally, where you just took a drawback out for living expenses or whatever, because you just couldn't afford to carry that $50,000 to that company forever and you just wanted to see some of it back. Nothing wrong with that, but just understand that that repayment to you is not going to show up on your profit and loss statement. Okay. The second place I typically find it going is excess inventory purchases or expansion of inventory. This is probably the most chronic problem in the industry because we are in an industry where we have thousands of new releases a year. And as a buyer for a store, it is trickier than ever to buy everything your customers might want or need, but yet not run out of money. And so you've got to be extremely discerning these days, I find, as a buyer from a company, to walk into a GAMA trade show or a distributor open house and not want to buy every single thing that's there. Because we're in an industry full of incredibly talented people that make some awesome games. And I find myself doing the same thing. I walk into, I don't own a game business anymore. I closed down Game Station in 14 to focus on my practice and to work full time doing business consultations and wealth management. But when I still go to Origins and Gen Con and do my speaking engagements, I typically will walk around the exhibit hall. And there's just an excitement in this industry that's palatable. You can feel it in the air. Everybody's happy to be there. They're happy to be selling and playing games, and it's infectious. And if I could show you right now my game library at home, it's probably like most of your all's game libraries. I have probably a couple hundred titles on the shelf, and just from where I'm sitting right now, I would say at least 2 dozen of them are still in shrink wrap. Now, why is that? Well, some of them are clients' games. I just want to support my client. Congratulations on their new release. So I'll line up in the line with everybody else on release day and buy their new product just to help them out, just to give a little back. Another reason is I see something or I demo something in school and I think at a show, sorry, and think, wow, that was super cool. I would really enjoy that game. Not giving any thought to the time it takes to play that game, the fact that my nearest local game store is 35 miles away, and that I don't really have much of a play community where I'm at because I'm in rural Kentucky. So I buy a lot of games, probably not as many as some of my friends I joke about on Facebook, but I buy a lot of games that go mostly unplayed. And I think on the retail end, it's like that amplified, right? They buy a lot of games that never sell because there's so much on the market these days, so much good product on the market these days that it is hard for any human being, let alone experienced buyer, but hard for any human being to be able to discern between, or to be able to divine rather, what the right purchases and the right amounts are for the thousands of SKUs that come out that are brand new every year. So net profit gives you that breathing room to pay yourself back, pay back creditors, expand your inventory, or maybe even put some coin in your pocket. That's not a bad thing either. So that's why you need to show a net profit, in my opinion, 7% or greater to give you some flexibility to do those things. Now we're going to move on to document number 2 that I feel is very important. We're not going to go into as much time on this one because this seminar really focuses more on the P&L, which is kind of your day-to-day operations. But we're going to talk about the second most important document, which is your balance sheet. And the balance sheet, just a short summary of what I would call a balance sheet. If somebody walked up to me in an elevator, I'd be like, your balance sheet is your accumulation of how you're doing over time. Okay, your P&L is more of a snapshot, right? Okay, over this period of time you did this. Your balance sheet is more of your storage closet. It's where all the junk goes, all the good stuff goes, on and on and on, and just accumulates. So on a balance sheet, there's 3 important numbers. Some balance sheets, again, are pages and pages long. Even when I had my game company for 12 years, our balance sheet was a couple pages long by the time we got done. But there's 3 important numbers I would consider on a balance sheet. Number 1 is total assets. Okay, now total assets is everything that's a plus, everything you've accumulated, right? That's a plus. So the sum total of all cash and bank account balances, plus inventory, plus furniture, fixtures, investments, and everything else that the company owns. Now, the thing is that if you're doing your business properly, assets are a great thing. They're a great thing to have. So you want to see your assets grow over time. The second most important number is your total liabilities. Your total liabilities equals the sum total of all your debts owed by the company, including your current bills, payroll taxes, bank loans, etc. The sum total, of all these things, basically it's what you owe, right? It's what you owe others, and others can mean the government, others can mean your bank, others can mean your family or you. Just what you owe others. You can mean vendors, accounts payable. So you've got your total assets, then you've got your total liabilities. The last section of a balance sheet is your total equity. Now, equity is kind of giving you an indication of what your business is worth overall. I get this question a lot in business consulting where people are thinking about transferring their business to another generation or selling it to somebody else in the industry, and they're like, hey, Aaron, what's your business worth, or what's this business worth? Well, equity is going to give you a clue into this. So equity basically is how well you're doing over time. So you take your assets minus your liabilities, plus your owner's paid in equity. That's like if you gave your company a loan to get started or a bridge loan, plus any previous year's accumulated retained earnings, which is the net profits you've had from previous years. So in theory, over time, this equity number is going to go up. If you're showing a net profit each year, regardless of what you do with the actual money you've accumulated, this is going to go up because it's going to show that accumulation of retained earnings. Now, of course, the assets are going to drop when you take money out of the company. But the thing is this basically takes a snapshot and it continues to record how well your company does over time. It's not uncommon to see retained earnings of several $1,000,000 over the history of a company. Because, you know, if you're making $100,000 a year or something and you're in business 30 years, well, that's $3 million right there of what would be showing in accumulated retained earnings. So the numbers in the equity section can become quite large if you become successful. On the flip side, the numbers on the equity side are a trailing indicator of if your company's not doing so well, because equity will become negative and continue to drift that direction if you continue to have losses year after year. So the balance sheet's a good snapshot of where you are at in time and how well you've done over time. The third document I want to talk about is called your cash flow forecast. Banks and financial institutions will also call this a statement of cash position. Now, it's usually done on a weekly or a monthly basis. It'll show your cash and your cash equivalent assets on hand, like any CDs you've got in the bank, your actual bank checking savings accounts, how much money you've got in your cash drawer. It'll also show you or subtract away any current liabilities on the books. So any wages, rent, interest on loans, things like that. It's also going to show, I remember I said earlier that you don't see principal, return of principal, loan principal on a P&L. It will show up on a cash flow forecast. So if you ended up at the end of year one giving yourself $1,000 back of that $10,000 you lent your company, it won't show it up on a P&L subtracted from your profit, okay? But it will show up on your cash flow forecast as, hey, you took $1,000 out of the company. Cash flow forecasts are kind of complicated to look at if you've never looked at one before, but are a very quick and easy way to tell if you're overspending on inventory, if you got people taking money out of the company that shouldn't be, or you got people that are overspending on credit cards and things of that nature. So cash flow forecasts, we won't get into too much here since this is a 101 seminar. But it is a topic that I have a separate presentation for that we'll give later, because a lot of people, once you understand what cash flow forecasting means, oftentimes a light bulb goes on among business owners in how to run their business successfully. So I think what we want to do now is we want to switch gears a little bit to how do I get these reports, right? It's one thing for me to tell you, okay, here's what they mean, but it's another thing completely if you can't get to those numbers to begin with. So I'm a big believer, as a QuickBooks Pro advisor, I'm a big believer in QuickBooks software. It doesn't matter if you use desktop or online or any of the number of flavors they've got. It will help you generate these reports on a semi-automatic basis. It isn't going to do everything for you though, right? It does take a certain amount of skill to understand what you're looking at, how you're setting it up, and things like that. But that's something that myself or your accountant or many other professionals have had lots of experience in getting it set up properly to where it'll automate these reports in the future for you. Yeah, it may cost you some one-time money to get it set up properly, but when I brought in a consultant to help me years ago at the beginning when I was getting into finance, I felt it was worth their weight in gold, the things that they taught me, many of which I'm relaying in this video to you guys for free. So I would recommend getting you a financial software of some sort. There's also other good packages available. I know customers that use Xero, which is another online accounting package. I know customers that use FreshBooks, which is another maybe slightly cheaper online package, but will also help you generate these reports. I think even these days, GoDaddy maybe has their own bookkeeping software you can subscribe to fairly inexpensively. I've seen Patriot Software has a simple accounting system you can subscribe to pretty cheaply. And then, of course, you can get up into more expensive systems like your NetSuites and Intacs and Oracle solutions and Peachtrees. So there's lots of different ways you can get to these reports without having to rely upon your accountant to do them or your CPA to do them for you. And by the time you pay a CPA to do these reports once for you, you probably could have already invested in most versions of this software and learned how to do these things on your own. So again, I would encourage you to seek out a consultant like myself or others in the industry that have an accounting experience. They could help you set those things up for a one-time cost or a small minimal monthly fee to consult you as you learn the systems on your own. Since we don't have an audience that we're talking to at the moment, a live audience, I'm going to forego the question and answers I've got on here. And instead, I'm going to switch to, let's get it up here. Okay, so now we're going to switch to an exercise I put together for you guys. So here is what I'm getting ready to show you is a profit and loss statement for a small game retailer, conveniently named Small Game Retailer LLC. And so in Small Game Retailer LLC, basically what we want to do is we want to analyze this P&L statement to where we can figure out the ratios on things and tell this business owner, hey, are you doing well or not? So let's start at the top. Remembering our 5 most important profit and loss statement figures, gross income, cost of goods sold, gross profit, fixed expense, and net income. Let's take a look at those numbers on this. 2 pages of numbers, we're going to boil it down to these 5 numbers. Number 1, total income, I hope everyone can see from this presentation here, is $551,173.69. Everybody see that? It's about 4 lines down or so under total income. Okay, great. That's the number that all the rest of these ratios are going to be based upon. So keep that number in mind. Now, cost of goods sold is going to take us a few more steps to calculate. But if you look under this column, cost of sales, and you go all the way down, you see total cost of goods, cost of sales, or total cost of goods sold, which for the case of this company is $197,176.64. If you do the math on that, you take $197,176.64 and divide it into the $551,173.69, you come up with a cost of goods sold of 35.8%. Our test is to make sure that that is less than 50% in a healthy game retailer, which it is substantially. Now, I also want to give you some danger ranges here, caution ranges and danger ranges. If you have cost of goods sold of 50 to 60%, you're in a caution range. I would start looking at your mix of inventory, and I would start looking at your buying decisions on what you're buying, or maybe start trying to accessorize what you're selling to try to bring up that margin. If you've got cost of goods greater than 60%, you are in the danger zone. You need severe intervention on your buying policies, or you need to not be discounting. That's where discounting shows up and things like that, because it's going to be tough to survive in a traditional brick and mortar model if you're going to have cost of goods over 60%. Now moving on, you'll see just a couple lines down your gross profit, which for this company was $353,997.05. This equals 64.2% of our gross income. Our healthy range, if you remember from our ratios, was more than 40%. So this company is doing very well. They're very much over that 40%. Again, I want to take a minute to give you cautionary and danger zone ranges for this number as well. If you run this calculation and you see that gross profit is 35 to 40% of sales, you need to be cautious, right? You need to be careful on your overhead spending, or you also need to look at your product mix again, or not discount as much, because That means you're going to risk not being able to cover your overhead here in a minute. If your gross profit is less than 35% for the game industry, for retailers I'm talking about, you need to do some serious rethinking of your business models, because it may not be sustainable unless you've got huge volume. And it's just a dangerous game to play, to discount things that far or to sell things at that little of a markup in this industry, but yet just try to make it up in volume. Typically the volume never comes, so you got to be cautious of that. Next, we want to go down into the expenses, and we want to take a look at what the overhead expenses were for this game retailer. I'll scroll slowly here for a minute so you all can kind of see maybe some of the interim items on things, and then we'll eventually get down to the total of all these expenses. Okay. Total expense is $252,357.33, if you can see that about 3 lines from the bottom. As a ratio of gross income, that ends up being 45.8% of sales. Now, according to our ratios I gave you a while ago for quick analysis, that is less than the 50%, which means this game company is running in a healthy overhead status. Again, the cautionary range is probably 50 to 60%, because in some areas of the country overhead is higher than others. Doesn't make it impossible for you to run a company in a higher overhead part of the world. You just either need substantially more sales, or you need to do a better job at buying and have more margin in things. So less than 50% is the margin we want, which this company, or less than 50% overhead expense is what we want, which this company has. 50 to 60%, I would advise caution. And if you're over 60% on your overhead, you really need to sharpen your pencil and take a closer look at what you're spending your money on, or if this business model is viable for the area of the world you've got it running in. The last part of the analysis I want to go through before our time is up is the net income. For this company, the net income was $101,639.72. or 18.4% of sales. This company did extremely well this year. And yes, before I get some flack, this was a game company retailer, and was a client of mine. So I can vouch for the fact that this is a correct P&L, and these numbers aren't just made up. It is possible. Again, our safe ratio, we want it to be 7% or higher. Obviously, they were well over that. Now, our cautionary number is 0 to 7%. Now, while 0 to 7% is still a profit, the reason I call it our cautionary zone is because if you have any debt, if you have any, well, just debt in general, right, it's going to have to come out of that net profit. Plus your wages. If you're not paying yourself, your wages are going to have to come out of that net profit. So if you have below 7% on your net, it's hard to take a salary. It's also hard to pay back any debt or loans you may take it from yourself or other family or banks or stuff. Now, obviously, the danger zone is if this number is negative for the year. Understand that in this P&L, I did not put in what's commonly known as accounting tricks like depreciation, amortization, things like that, because I wanted to kind of show you what a P&L would look like straight from your system. Now, by the time your accountant gets done with it for income tax purposes, if they add in depreciation and some things like that, and it brings down your net profit to below 7%, you'll be fine. But in general, don't be surprised if you're showing your P&L shows a huge loss or a huge profit, then all of a sudden when you file taxes and your accountant comes back and their net number was not your net number, because some of those tax accounting tricks like depreciation will drastically change those numbers in some years. So I hope here at the end of the day you guys got something from my presentation. Again, my name is Aaron Witten with Witten Financial Services, presenting Finance 101 for the game industry. Feel free to contact me with any questions at the contact info here on the site or below. I'll be glad to do a free consultation for anybody that needs it, or email me your questions anytime and give me a couple days and I'll be glad to answer them. Thanks a lot.